Geopolitics with David.
In just 8 days, the U.S. financial system hits a date that can quietly change prices, rates, and risk appetite without a single stimulus check headline. January 26, 2026. That's when the IRS opens the filing season and the refund pipeline starts moving. And if you think that's just paperwork, you're missing what this really is, a liquidity event with a clock on it. Because when money starts flowing back into millions of accounts at once, it doesn't land in the economy as an abstract concept. It lands in your credit card balance, your rent, your car payment, your brokerage app, and the price tag you see at the store. And this year, that pipeline is colliding with something else. A White House push to loosen financial conditions through housing markets, while the Federal Reserve has already shifted its balance sheet stance away from runoff. Put it together, and you don't get a crash. You get a flood. Not a moral story, a mechanical one. And by the end of this, you'll understand 3 things clearly. What exactly hits on January 26th, how the money actually moves, and what signals tell you if this turns into a short burst or a longer, more dangerous wave. I'm Professor David O'Brien. I've spent years studying how policy shows up downstream, not in speeches, but in funding markets, mortgage spreads, and household bills. This is not a cheerleading video, and it's not a hate video. I don't care who you support. I care what happens when multiple liquidity levers get pulled at the same time, because the country has seen this movie before, and most people only notice after prices have already moved. This is educational content, not financial advice. Do your own research and consider professional guidance. Here's the map. Fast, simple, and you'll feel the logic click into place. First, the trigger date, January 26th, and why refunds act like a timed release. Second, the hidden mechanism, how refunds, mortgage bond purchases, and central bank reserve operations can all point in the same direction even when officials insist they're unrelated. Third, the pattern, 3 historical echoes that show what liquidity bursts tend to do to assets and to everyday costs. Fourth, where we are right now, which stage this resembles. And finally, the watch list, the few indicators that tell you whether this stays contained, or whether it spills into inflation, volatility, and political conflict. Now let's lock down the first piece. What January 26th really means. The IRS has said the 2026 filing season opens on Monday, January 26, 2026. That is the first day taxpayers can begin filing 2025 federal tax returns, and begin filing sounds boring until you remember the scale. The IRS expects on the order of 160 million individual returns this season, with most filed electronically. A portion of those returns will produce refunds, and refunds at scale behave like a release valve, not because they create brand new money in a magical way, but because they return money that has been withheld. Households don't experience it as a correction in withholding tables. They experience it as cash showing up, and cash showing up at the same time for millions of people changes behavior. This is where the story gets sharper because 2026 isn't a normal refund season. Multiple analyses and official guidance point to larger refunds for many taxpayers due to changes tied to the One Big Beautiful Bill Act, and the IRS itself is directing people to information about those provisions as something that may lower tax bills and potentially increase refund amounts. The Tax Foundation has also discussed how refunds can rise when individual tax burdens fall and when withholding doesn't instantly adjust, because that creates overpayment that later comes back as a refund. You can argue politics all day. The mechanism doesn't care. If withholding lags reality, refunds surge, and the timing concentrates cash flows into a window. So what does flood the market actually mean in this context? It means liquidity arrives in waves that hit different pipes. Wave 1 is simple: household cash flow. For many households, refunds don't become long-term savings. They become relief. They pay down revolving debt. They catch up on bills. They refill checking accounts that have been running too thin. And even when people do save, the money often goes somewhere that touches markets, money market funds, brokerages, retirement contributions, or a delayed big-ticket purchase that pulls demand forward. That's why this matters, because demand pulled forward looks like growth in the short run and like inflation pressure in the medium run, depending on supply constraints and financial conditions. But the refund pipeline is only one side of the story. The second pipe is housing. And this is where things get politically explosive and financially real. In early January, President Trump said he was ordering his representatives to buy $200 billion in mortgage bonds, with the stated goal of pushing mortgage rates down and making ownership more affordable. Reuters reported the directive and the follow-up, including that the Federal Housing Finance Agency's director said Fannie Mae and Freddie Mac would execute purchases, and that they had started with an initial round of purchases. Whether you think that's brilliant or reckless, understand what it is mechanically, an attempt to compress mortgage spreads and ease financial conditions through the housing channel. It's not a law of physics that it will work forever. Rates can rebound for many reasons, but it is an injection aimed directly at the cost of borrowing for homes. And then there's the third pipe, the one most people never look at: reserves, the Fed's balance sheet stance, and the quiet plumbing of money markets. In late 2025, the Federal Reserve announced it would cease the runoff of its securities holdings starting December 1st, 2025, effectively ending that phase of balance sheet reduction, and it directed reinvestments into Treasury bills. In December, the Fed also announced it would begin technical buying of short-dated Treasury bills to manage liquidity and maintain control of its interest rate system. Again, officials insisted this wasn't QE. The label is less important than the direction: less runoff, more reinvestment, more purchases, and a policy posture designed to keep reserves ample. And in mid-January 2026, Reuters reported the New York Fed desk planned over $55 billion in asset purchases between January 15th and February 12th, including reinvestments and reserve management purchases. Translation: the central bank is actively managing liquidity in the background. Now I want you to see the shape of this. January 26 triggers the filing window, the refund pipeline begins. Early January triggers the mortgage bond purchase directive, an attempt to push rates down through MBS buying. Late 2025 into early 2026 triggers a shift in Fed balance sheet operations, a move away from runoff and toward purchases for reserve management. These are three different institutions, three different public narratives, and three different political incentives. But if they all push financial conditions in the same direction at the same time, the effect can converge. Easier money, more risk appetite, and a faster circulation of cash through markets and household spending. Here's the simplest analogy with zero jargon. Imagine the economy as a city with three major water mains. One main goes to households, paychecks, refunds, benefits. Another main goes to housing, mortgages, refinancing demand, the cost of monthly payments. The third main goes to the financial system itself: reserves, money markets, and the plumbing that keeps banks and funds stable. If one pipe opens a little wider, you notice. If all three open in the same season, you don't just get more water. You get pressure changes. Some neighborhoods flood, some get a temporary boost, and some get higher prices because demand arrives faster than supply can respond. That's the risk. Not that the system instantly breaks, but that it becomes unstable, hot in one place, fragile in another. So what happens next? Let's walk through the timeline the way markets actually feel it. Stage one is anticipation. This is where we are right now. Before refunds hit, people position around expectations. Lenders market refinance offers, retailers forecast demand, and investors start front-running sectors that tend to benefit when household cash flow improves. At the same time, the mortgage bond directive signals a political priority: housing affordability. When policymakers lean on housing, it can temporarily shift psychology. Rates might come down. Maybe I should move. Maybe I should refinance. Maybe I should buy. Even if rates bounce back, the attempt itself is a signal. They want easier conditions. Stage two is the first deposits. Once filing opens, a portion of taxpayers file immediately, and for simple returns with direct deposit, refunds can arrive quickly. Not everyone, not at once, and there are processing realities. But you don't need everyone. You need enough deposits, concentrated enough to change short-term behavior. The market doesn't wait for the full total. It reacts to momentum. The first burst shifts sentiment. People have cash, and sentiment is the invisible bridge between cash flow and price movement. Stage three is spillover. Household refunds go first into balance sheet repair, debt, arrears, essentials, but then into discretionary spending, and finally into asset behavior. And here's where it gets uncomfortable. When risk appetite rises while the Fed is still managing reserves to keep money markets smooth, asset prices can inflate faster than wages. That is the silent tax most people never name. It's not just inflation at the store. It's the cost of buying assets later because the entry price moved while you were still paying bills. Now let's ground this with evidence because otherwise it sounds like vibes. We have official confirmation of the filing season start date, January 26, 2026. We have official Fed documentation that runoff ceased starting December 1st, 2025, with reinvestments into Treasury bills. We have Reuters reporting that the Fed began technical bill purchases starting December 12th, and that the New York Fed planned over $55 billion in purchases from January 15th through February 12, and we have Reuters reporting on the mortgage bond directive of $200 billion, including that initial purchases began. Those are not rumors. Those are the moving parts. The debate is not whether the parts exist. The debate is what their combined pressure does when they overlap in time. So why call this a flood at all? Because liquidity is not just created by one giant bill labeled stimulus. Liquidity is a condition, and conditions can change through multiple levers: tax timing, asset purchases, reinvestment policy, and targeted interventions that compress borrowing costs. When enough levers point the same way, markets behave like they're in a different weather system. Now, 3 historical echoes, not to claim history repeats perfectly, but to show the pattern. First echo, the 2019 repo shock and the lesson of reserves. In 2019, the US money market experienced a sudden funding squeeze, and the Fed responded with Treasury bill purchases. The core lesson wasn't ideology, it was mechanics. When reserves aren't as ample as models assume, liquidity can tighten fast, and the central bank moves to keep control. Fast forward to late 2025, the Fed explicitly cited signs of tightening liquidity when it decided to stop runoff and shift reinvestments. That's the same category of lesson. Reserves matter, and the Fed will act to prevent funding stress from spiraling. The punchline that mirrors today is simple. When the plumbing looks strained, the Fed doesn't wait for headlines. It changes the flow. Second echo, policy-driven easing through housing channels. We've seen governments and central banks try to influence mortgage rates through MBS markets, sometimes directly, sometimes indirectly. The difference here is the institutional route. The directive described by Reuters points to housing finance giants being used as a lever to buy mortgage bonds with the goal of lowering rates. That's a big signal, even if the effect is temporary. The punchline that mirrors today: when housing becomes politically urgent, the system reaches for balance sheet tools, and markets learn to trade the signal as much as the substance. Third echo, tax timing and concentrated household cash flow. Whenever policy changes or withholding mismatches create larger than expected refunds, you get a seasonal cash pulse. The Tax Foundation's analysis emphasizes that refunds can rise broadly under tax changes, but also warns that a bigger refund isn't free money. It's often the return of overwithheld income. And yet households treat it as cash arriving, which can concentrate spending and debt paydown into a short period. The punchline that mirrors today is uncomfortable. Even when it's your own money coming back, the timing can still move demand and prices. Now let's snap the pattern onto the present. Where are we in the cycle? We're in a phase where policymakers are trying to keep conditions supportive, while affordability and cost of living pressures remain politically sensitive. The Fed has shifted away from runoff and into purchases framed as technical, designed to keep reserves ample. The administration is signaling housing affordability as a high priority battleground and has tied that goal to MBS purchases by housing finance giants. And the IRS filing season opens January 26th, with official guidance that tax law changes may affect refunds. That combination means we are in a supportive liquidity stage, not necessarily permanent stimulus, but an environment where liquidity is being protected and in some channels increased. So what's the next domino? It's not stocks to the moon or instant collapse. The next domino is perception. If households feel relief and housing headlines suggest rates can fall, risk appetite increases. If risk appetite increases while the Fed is actively managing reserves and purchases, markets can run hotter than fundamentals. And when markets run hot, you get 2 things: asset inflation and political backlash. The mini cliffhanger is this: the real test will not be January 26th itself. The real test will be what happens when these flows meet reality, in inflation prints, in mortgage spreads, and in the Fed's tone around the January 27th to 28 meeting window. Now let's address the skepticism before it spreads, because it's healthy skepticism, and it's where smart viewers separate from distracted ones. Objection 1: refunds aren't new money, so they can't flood anything. True in an accounting sense, incomplete in a behavioral sense. A refund is often the return of overwithheld wages, but macro effects aren't only about whether money is new, they're about timing and concentration. 10 billion spread across a year is not the same as 10 billion arriving in a month. Timing changes decisions: spending, saving, refinancing, and risk-taking. And timing is exactly what January 26 coordinates. Objection 2: a mortgage bond order won't matter. The market is too big. Also partly true. Even Reuters reporting and market commentary have noted uncertainty about details and timelines, and mortgage rates can rebound for many reasons: inflation expectations, Treasury yields, risk premiums. But again, the first order effect isn't only the basis points, it's the signal. The administration wants easier housing conditions and is willing to use balance sheet style tools through housing institutions. Markets trade signals, and signals can move expectations even before the full program executes. Objection 3: the Fed says it's not QE. Fine. Call it reserve management, technical purchases, reinvestment strategy. The label doesn't change direction. The Fed stopped runoff starting December 1st and started buying bills starting December 12 to manage liquidity. Reuters reported it, the Fed documented it. The system is being kept liquid enough to maintain control of rates. That's the reality that matters to market conditions. Now, the clock and the watch list, this is where you turn fear into clarity. I want you to watch 6 things, and I'll tell you exactly what each one means. 1. The pace and tone of Fed Reserve management purchases. If the New York Fed's schedule stays heavy beyond the current window, it suggests the system needs more liquidity support than officials want to admit. If it tapers fast, this may stay contained. 2. Mortgage spreads versus Treasury yields. If Treasury yields rise but mortgage rates don't rise as much, spreads are compressing. That's a sign the MBS buying and related forces are affecting the housing channel. If spreads blow out, it means risk premium is winning and the policy lever is weaker than advertised. 3. Refinance demand and housing activity signals. If refinancing surges, cash flow changes for households that successfully refinance and that can feed consumption or debt paydown. If activity stays flat, then the directive may be more signal than substance. 4. Inflation expectations and the Fed's posture. Reuters reported Fed leadership emphasizing data dependence and a stance they view as well-positioned. If inflation reaccelerates while liquidity remains supportive, the risk is a policy whiplash later, supportive now, tighter later, which is exactly how volatility is born. 5. Consumer credit metrics. A refund wave often shows up as credit card paydown first. That can temporarily improve household balance sheets, but if it's followed by a surge in discretionary spending, you can get demand pressure without lasting financial repair. 6. Political escalation. If the public perceives markets up, costs up, you get backlash. And backlash creates policy noise. Policy noise creates risk premiums. Risk premiums show up as higher costs, including for government borrowing and household borrowing. That's how politics translates into your wallet without asking permission. Timeline: near, mid, long, with uncertainty but clear direction. Near term is late January through early March. Filing opens January 26th, early refunds arrive for early filers, housing headlines continue, and the Fed's January meeting tone matters. Midterm is spring into summer, refund effects fade, but if the housing channel and reserve management remain active, markets can stay buoyant longer than fundamentals justify. Long-term is late 2026 into 2027. If asset inflation builds and inflation expectations rise, policy conflict intensifies, and the system can shift from supportive liquidity to containment mode. That phase change is the real danger because it's when volatility spikes. So, how does this affect you as a normal American? Not a trader, not a pundit. 3 ways. First, prices. If demand gets pulled forward, more spending, more travel, more home projects, some prices rise simply because supply can't expand overnight. Second, borrowing costs. If policy actions temporarily compress mortgage spreads, some borrowers get relief. But if inflation expectations rise, overall yields can rise and offset the relief. Third, wealth inequality by timing. If assets run before wages adjust, people who already own assets get richer faster, and people who don't feel like life is slipping away. That's not ideology, that's timing. Now, the practical protocol, principles only, no hype, no buy this. 5 steps. Step 1, don't confuse a temporary cash pulse with a permanent new income level. Treat refunds as a one-time timing event. The biggest mistake is upgrading your monthly lifestyle on a seasonal bump. Step 2, reduce fragility. Fragility is high-interest debt with no buffer. If extra cash arrives, strengthening your buffer lowers how much markets can hurt you later. Step 3, watch duration in your life. Duration isn't just bonds, it's commitments. Long leases, big fixed payments, high monthly obligations. In volatile policy environments, shorter commitments reduce risk. Step 4, diversify your personal exposure. Not in the Wall Street sense, in the life sense. Don't let one single variable control your stability. One employer, one income stream, one high monthly liability. Step 5, do not chase headlines. The flood narrative makes people impulsive. The worst move in liquidity cycles is emotional leverage, taking on risk because you feel late. Liquidity phases can run longer than you expect, and they can reverse faster than you can react. If you want to leave a comment, I'll give you one question worth answering. Which signal matters most to you? Refunds, mortgage rates, or the Fed's balance sheet operations? And why? Now the landing. January 26th is not magic. It's a switch that turns on a pipeline. And in 2026, that pipeline opens into an environment where housing policy is being pushed through mortgage bond purchases, while the Fed has already shifted away from balance sheet runoff and into active reserve management. The mechanism is simple. Multiple liquidity channels moving in the same direction can lift risk appetite and spending, and that can raise prices, compress spreads, and distort signals. The stage we're in is supportive liquidity with political urgency, and the key risk is phase transition. If inflation expectations rise, the same system that eased can suddenly tighten, and that's when people get hurt.